Hello, we've got 66, 75 people already on the call. Welcome. Who we got in the chat? Daniel, good morning. Where are you located? Because it's morning for me here in San Diego. Portland, West Coast, represent. Good morning. Hello, Minnesota, South Dakota, Pittsburgh. Good morning, good afternoon. New York, Sacramento, my hometown. Cool. Rhode Island. We got the whole country here this morning. Welcome, everybody. Who's in the coldest climate? What do we got degrees wise? I'm in San Diego and it's like a 60-degree, beautiful, clear sky morning. 35. Ouch. Welcome, welcome. 39. Okay, almost freezing. Balmy 41. Deb, you might be traumatized. Let's see. Well, good morning, everybody. I hope you're ready to ask some good questions about being self-employed and tax time. That's what we're here for. In Nort, 40 in Chicago. Very cool. Well, welcome. We'll get started. This first section of this webinar is just a quick overview about Collective. I'm going to share some key deadlines. We'll send you a copy of this deck after the webinar, so don't feel like you have to take excruciating notes. We'll be able to dive in and send you these materials after. Let me pivot to my screen so you guys can see the presentation. La Jolla, someone's in La Jolla. Let's see, I don't have the chat visible. I'm on one screen this morning. So bear with me. Let's see. How are we doing? Can we see the presentation okay? Anyone in the chat want to give me a thumbs up? Sweet.
We can see
All
it, but we
right.
can see your whole browser.
Okay, let's see. I'm remote. I'm in San Diego on a little trip and I want to see the chat because I'll get FOMO. Give me one sec. How much money do you suggest? Leslie, we will get to questions for sure. We can talk about that. Give me one sec. Share full screen. I'm just going to level with you guys. It's my first webinar and I'm stoked to do this, but if you see me struggle with the screen share, I'll just level with you. I'll be honest. I'm new to it. Okay. Does this work? I'm just going to say this works because I think it's more important for me to see your chat and what's going on. Okay, so a little bit about me. I'm Marissa. I've been with Collective for over 3 years. I'm here on the sales team, so I actually take these introductory calls, answer all the questions about self-employment, help people decide whether or not an S Corp is the right fit for them, ultimately if Collective is the right fit for them. I come from old school public accounting, so I was a tax accountant prior to this, so it was a real neat transition over to Collective to use that unique experience in a different context. So I'm super excited to be sharing some super exciting information with you all. What we're going to talk about, again, the first or the next 10 minutes is going to be real short. Key deadlines, what's coming up for this tax season, some things to look out for in terms of federal and state filing obligations. How can you make sure you're covering all the bases? Some super high level strategies for self-employment, and then we'll get into the meat and the potatoes, all your questions. So be prepared and we'll dive into the Q&A. Does that work for everybody? I can't see the chat if we get the clean presentation mode. I'm sorry. But here we go. This webinar is for educational purposes only. So feel free to acknowledge this disclaimer. Okay, so who is Collective? Collective, we're an online platform specific to self-employed individuals. So we support folks across various industries. We've got content creators. I know there's some nutritionists and dietitians on the call, graphic designers, people in film and production, real estate agents across the United States. So we are built specifically for many of the folks here on this call, helping them run and grow their businesses via an S Corp. Straight to the not fun stuff. I'm not going to read through this slide, but just want to call out a couple deadlines that are going to come up. Take a screenshot. We'll send you a copy of this slide. But the IRS filing season is officially open. So that means you can start submitting your tax returns if your employers or your 1099s have sent you all your documents. If your books are closed, you can start filing. So that happened yesterday. If you are an existing business, S Corp, payroll, you've got some upcoming payroll tax deadlines. Really, for the bulk of us, we're going to be focused on the March and April 15th deadlines coming up. And those are the deadlines to either file or extend your S Corp. So if you have an S Corp already, the S Corp's due March 17th this year since it falls on a weekend. April 15th for the rest of us that just file a simple personal tax return with Schedule C, due or extended April 15th. And I'm just going to take a peek over at the chat if I can. Can I get my trusty collective teammate, Clay or Sarah? Is there anything in the chat going on that I can pause and answer real quick?
No, just a reminder for everybody to use the Q&A feature at the bottom of the Zoom with any questions that you guys have, and Marissa's gonna try to answer every question as they come in, but we are gonna save Q&A for the end of the webinar. So as opposed to using the chat, please use the Q&A. It's a little question mark down at the bottom.
Thank you very much. All right, so I'm going to pivot over real quick. We're not going to stay here too long in this presentation style. We'll pivot over to the questions real shortly here. Tax season tips. So super high level call out. I'm sure that this just happens organically when you file your personal tax returns. Most of you will live in a state with a state obligation. There's a handful, Nevada or Texas, where you are lucky enough not to have state income tax. For the rest of us, when you file your federal return, there's almost always some state level attachment. So really just be aware that sometimes there's different deadlines if you extend. Sometimes there's a separate extension form. So really just being aware that there could be additional filing requirements outside of just the federal tax return. Extended deadlines. So extensions have a bad rap. Millions of taxpayers file extensions every year for both business and personal. What does it do? If you need more time to wrap up your books, if you want more time to make certain retirement contributions, if you are going on vacation and you just don't feel like dealing with your taxes around April, the IRS will allow a 6-month extension. You do have to file or submit a form, so it's not an automatically granted extension. So you can proactively make that choice to extend your return. The extension is due by those March and April deadlines, and it gives you extra time to file, but not pay. So if anyone has questions on what that means, we can definitely dive into it. But really by these original deadlines, the IRS and the states want you to submit some form of tax payment if you anticipate owing. But you may get time to extend the actual filing deadline. The piggyback rule, all this means is that some states will just follow the federal rules. So if you follow or if you file a federal extension, your state may just automatically accept it. So that's something to be aware of, depending on where you live, if your state follows any federal extension rules. Another pro for filing an extension proactively is you can avoid late filing penalties. So if you know you're going to be out of town or you're waiting on, somebody else to give you a tax form, proactively filing the extension instead of just like waiting to see if you can make it in April, that will help avoid late filing penalties And again, you still want to try to make that estimated tax payment. Pro tips, mark your calendar. We've got this snip of the upcoming deadlines for the first quarter of 2025. So feel free to copy and paste those deadlines onto your calendar if they apply. And then proactively planning for your tax bill. So quarterly estimates are probably part of most of your lives. The idea behind them is you pay into your tax bill a couple times throughout the year, because if we're self-employed, we don't have withholdings. And really the IRS, the states, they want their money sooner than all at once in a lump sum at the end. And so by paying in those quarterly taxes, one, it avoids a huge cash flow issue at year end with a large balance due, and it reduces the risk of the IRS assessing underpayment penalties and interest on what you might owe. So strategies, we can get into the details because a lot of this will depend on your industry, what you do. Super high level, I want to touch on the best advice any accountant, CPA advisor can give you when you're self-employed is you want to capture as many deductions as you can. Like you want to lower that taxable profit. And the best way to do that is to be aware of what you're allowed to deduct. The IRS has this rule. It's called, or they refer to it as expenses need to be considered ordinary and necessary to generate revenue for your business. And so that's going to be really dependent on what you do, how you perform your job, where you perform it, what industry. So if y'all have any specific industry questions, we can dive into that in the Q&A. But best advice, lower that business profit, and that's what you're taxed on. Once you've exhausted all your options, all your deductions, then we start to pivot to these other concepts. Maybe you're into tax deferred retirement plans. So tax deferred means you get a deduction in the year that you make the contribution, and then you pay the tax and you take it out upon retirement. So if you've written off all you can from a normal business operating perspective, one of the next pivots you can consider to further lower your tax bill is contributing to a tax deferred retirement plan. Another one we touched on, it doesn't necessarily reduce your tax, but it helps mitigate some cash flow issues, is paying in quarterly. Maintaining accurate records. I know this is probably something that everybody says. The reason why it's so advantageous is it can give you insights on where you're at. A lot of times at year end, you might hear people talking about like, oh, it's December, I need to buy a business vehicle, or I need to, reinvest in my business. So having a pulse on where your business profit is at throughout the year can help you make those decisions throughout the year instead of like a panic decision at year end. So maintaining clean books and accurate records can help you do that. Then this is where collective can step in. If you've exhausted these options, business write-offs are complete. You've purchased any equipment that you need, new cameras, lenses, if you're a photographer. If your profit's still over 60,000, then maybe we want to reconsider what our tax status is. And is it time to maybe think about the S Corp election? Super quick, we don't have to get into how all of that works in depth. It's a lot of maths. But really what the S Corp election does is it gives you an opportunity to control and reduce how much you pay in self-employment tax. So most of you, if you're already filing on a Schedule C and you were to look at your tax bill and do some numbers, you would see a 15.3% self-employment tax assessed on your Schedule C business profit. After that, you'll still get income tax assessed on top of that. And then if you live in a state with income tax, you'll also have that layer of tax. So really having the ability to control where this self-employment tax lands is a huge savings opportunity. The downside is that it's more costly to operate. There's a higher administrative burden. You have a need to file payroll and pay yourself a reasonable salary. There's a need for more comprehensive bookkeeping. You now need a balance sheet and a profit and loss statement. And then a separate business tax return is triggered. So the compliance greatly increases, the cost to operate increases. And so finding a support system, this is what Collective is built for, um, to wrap all that up into one platform. So it's convenient, it's cost effective, you maintain compliance, you can capture the advantage of being an S Corp without doing all the work yourself. And so considering your tax status, once the rest of these bullet points have been addressed, um, is a really great opportunity for self-employed folks. I'm gonna take a breather. Anything in the chat going on? I'm gonna take a look, but it might show you my browser, which here we go. Paul, you asked 15th or the 17th. This year is the 17th because it falls on a weekend. Let's see. These are questions. So before I get into all these questions, I'm gonna make sure I get through these slides. So bear with me one sec. Oh, here we go. We're there. Let's see, and give me one sec. I'm also gonna look at the Q&A. Okay, I am going to just start addressing these questions. I've got 16 already. If you posted a question in the chat, please, if you can, just copy and paste it into the Q&A and we'll just dive into it. All right, so Paul, again, this year, the March deadline for S Corps, so pass-through businesses, if you've got a partnership, a trust, or an existing S Corp, the deadline this particular year is March 17th. And then if you were to extend, it would be, September 15th or 16th or 17th, depending on where that falls this year. Dave, do I have to renew the S Corp every year? No. Once you make the election, it is in place and it tells the IRS that you are agreeing to maintain the S Corp compliance. There's a couple things that can happen that take away S Corp status. You as the owner can proactively revoke it, which we can talk about in depth. Usually it's not a good idea if you're going to maintain that same business because you're not allowed to re-elect for 5 years. If you don't maintain compliance, so not filing the S Corp tax return, not paying yourself a reasonable wage, and it gets flagged by the IRS can revoke the S Corp election on your behalf. Should I receive a notice from the state? You will get an IRS confirmation. Once you've submitted, it's called Form 2553. You'll put the name of the LLC or the entity that's electing, the effective date that you want. When the IRS receives it, they'll send a letter that'll show like we've confirmed and accepted your S Corp election or we've rejected it. There are instances where if like a signature is missed at the bottom of the election, the IRS could reject it and then you'd have to resubmit. At the state level, it depends. So some states will, it's the piggyback rule again, some states will automatically follow the IRS S Corp election, which means if the IRS agrees to treat you as an S Corp, then the state also does. And then you would just make sure you're filing the state level S Corp returns. If your state, and some states have this, I think New York is one specifically, it requires a separate standalone state level S Corp election. And so that would be something that you may have to investigate. Here at Collective, we will do that for you. We know which ones require a standalone state election. In which case, if you do have that, I do expect that the state would also send a confirmation letter. That was a really long-winded answer, Dave, but I hope that helped. Deb, what if I started my business end of year 2024, but I haven't made any money yet? Do I need to file? Single member LLC. So Deb, you will add a Schedule C to your personal tax return for 2024. And you want to make sure the reason you want to include this business activity is you can start deducting, your startup costs. Really what the IRS wants to see like in a long-term situation is that there's an intention to generate revenue. And so just because it hasn't happened yet, it doesn't mean that you're not entitled to the deductions. So, for such a short period of time, a simple Excel spreadsheet is probably sufficient. Just track the money that you've put in for your LLC formation. If you paid LegalZoom or whoever it was, Any other startup costs, like maybe education, certifications, and those can all be deducted on your Schedule C for 2024. Does filing benefit or hurt me? Benefit you. You can deduct those costs, which will absolutely help you lower your tax bill a little bit. Sam, if I have an LLC, if it's a single member LLC, then all that activity is filed with your personal tax return, and that deadline is April 15th. If it's an LLC owned with like business partners, then it's considered a partnership, in which case it files a separate tax return, and so the deadline would be March 17th. If it's an LLC that elected S Corp status, again, it's going to be the March 17th deadline. Trisha, let's see. Can I write off insurance if I'm paying into my husband's company insurance for the family? Usually the rules with self-employed insurance and it being deductible, there's usually a stipulation where it says that it's only deductible if other insurance is not available to you. So if you have coverage through a spouse's health insurance plan, my understanding is that self-employment insurance would not be deductible because there's a solution elsewhere in the household. Can you write it off if you're paying into? Maybe your question is more nuanced than I'm reading, Trisha. I may have to think more about that one. But overall, if there's insurance provided by a partner's employer, it would be disallowed as a deduction for the self-employed partner. Some anonymous attendees. Let's see. Are these going to be the hard ones? How do we handle contracted workers through agencies? Do I send an agency 1099? Does this count as a deductible business expense? So the easy answer is yes. If you pay agencies or contractors for any sort of support, that is a deductible business expense. The first part of your question, it depends on how you're engaged with the agency. I think sometimes you pay an agency like a fee, in which case like just the fee is deductible. So on your profit and loss statement, you just might see a flat fee to the agency instead of to an individual. In that circumstance, they're treated as a vendor. So, 1099 would not be part of it. If you're paying an individual directly, so the agency just feeds you potential contractors and then it's on you to engage with them separately, that's an instance where you would more than likely issue out 1099s to that individual. So it depends on the relationship with the agency. Let's see, I paid my kids via LLC in 2024, but I don't have an online W-2 service. Do you suggest using the official paper copies? Michelle can also include any benefits. Let's see. So you paid your kids, anonymous attendee. This would depend. When you say you paid them, did you just give them cash? If you didn't run them through like a payroll software, more than likely it sounds like it would be more of a 1099 situation. When you're employing someone formally, not just having somebody do work for you, employing is the way that you actually pay them. Employment means that you as the employer take on some kind of obligation for that employee. So you're paying some of their payroll tax. You may be required to do health insurance or, I don't know, 401k or some type of benefit. When someone is a contractor, they're self-employed. So just like most of you, they're self-employed. So they just get a lump sum payment. The 1099s are a simpler tax form where you can do like a write-in. The IRS has actually a free 1099 generating portal. I would suggest that. That's real simple. Manually doing payroll is a lot more complex. So I get the sense, anonymous attendee, that your kids were 1099, in which case you can use the IRS's really simple 1099 filing system. Can I also include any benefits like paying for the private school, but for those ones? More of a nuanced question here that I don't know the answer to, frankly. I think there are specific funds and ways to contribute to your children's education that become deductible. I'm not an expert on this, but 529 plans might be the path to getting some sort of deduction like that. I'm sorry, I don't have a better answer for that. But I would look into 529 plans, usually as a 1099. So if you just paid them a lump sum, benefits like education would not be included. How much do I need to make to change to an S corp? So I'm going to answer this in two ways. One, the IRS doesn't stipulate a line or an income threshold. You can be an S corp with a loss. Really, the perspective or the lens that we take is, when does it make sense to switch to where your savings potential exceeds the cost to do the extra work? So Jennifer, usually we see that line at around 60,000 of profit. So revenue minus all your write-offs, what's left over is the profit. Once it's beyond 60,000 for our members, that's where we see their savings potential exceeds what collective costs to do the extra work. So you don't have to make any amount of money. You can do it if you want. But 60,000 of profit is where people will usually see a net savings. How are we doing on time? We've got a lot of good questions in here, and I think I'm going a little slow. So if we need to run over, we can stay on. We can do, this will be recorded. So if I don't get to your question within the 45 minutes that we had, fear not, we will find a way to get you the answers. Okay, anonymous attendee. I do books for a single member LLC. The owner did not have his payroll run for 2024. If we backfile the request for it, can I backdate payroll to 2024? This question is a little tricky. I'll tell you my gut reaction as a previous tax accountant. It's really difficult to get catch-up payroll done for a complete prior year, especially because the deadline is coming up in 3 days and the payroll tax should have been remitted by January 15th. That's not to say it's not doable, but it's really more of a question of, do you feel comfortable manually filing? You'll have the Q4 payroll tax returns for both federal and state, and then you'll have all the annual payroll tax returns for federal and state. Depending on whether or not he's even set up as an employer yet, you may have to apply for an employer registration. So there can be a lot of hurdles to achieve this. Is it doable if you're comfortable with payroll? Yes, I think so. I think a lot of people do this. Is it worth the headache? Maybe it depends on how much profit this person had in 2024. If they were, like frankly, at 60,000 of profit or under 100,000 of profit, maybe the effort is not worth it to get the catch-up payroll. You'll also have that March 15th S Corp deadline coming up. So it would mean you'd have to, well, you do the books, but you need the books, file the S Corp tax return, but really the payroll piece is going to be challenging. Doable? Yes. Pain? Also a yes. I think that was kind of a non-answer, but I hope it was helpful context. Kelly, if I'm required to look professional for client calls or some business only clothing, that's a great question. I was just at a conference for content creators and this came up. Generally, clothing is not deductible, regardless of your industry or profession, generally. Like this top, what the IRS says is this shirt means I can wear this outside of work. I didn't buy it just for work. So usually the uniform concept does not apply to most people. It would not be deductible because the clothing can be used outside of work. In the context of the conference I was at, these people were creators with a very specific look, vibe. They really truly were wearing costumes, in which case, there's no other purpose for that reasonably in a normal context. in which case that would be considered deductible. So, accountants have this joke, what's this tax rule? How does it apply? The answer is always going to be, it depends. So Kelly, unfortunately, it depends, but more than likely just writing off like a sports coat or a suit, that won't be deductible. Oops, going the wrong way with this slide deck. I'm sorry. Here we go. Michael, can you write off any supplemental retirement plan like an index universal life insurance policy? There are some, I don't know, Michael, flat out. But in my time in tax, there were some specific rules about deducting the life insurance premiums for the owner of a business. And if I recall, maybe specifically life insurance was non-deductible. Like it's a very specific part of the tax code where one thing is non-deductible. So I'm not sure. There may be some other supplemental retirement plans that are deductible. But usually life insurance, from what I've seen, is disallowed. Are there specific deductions that trigger audits? I use my home for telehealth, but I'm worried about bringing it on. The home office deduction tends to be more auditable. But if you use it properly, then I wouldn't worry about it. It's a deduction you're entitled to, especially if you work from home. The short version of how it works is you'll allocate a percentage of your home, so square footage of your home office space divided by the total square footage of your home. That becomes a percentage that then you would apply to that utility bill or phone bill or renter mortgage payment. I think most people end up taking it ends up being 20% on average of their total home costs. And so I think if your space is kind of somewhere in that range, I wouldn't be concerned, just document it. The best thing you can do is document like, this is my workspace, my sole place for work. I don't also pay for office, shared office space. But anonymous attendee, you are entitled to deduct a portion of your utility bill, and then other home expenses. If my only employees are my minor children, do I still need to file 940, 941s? Again, this depends on if they're truly set up as formal employees. So are you running payroll with withholdings through like a payroll provider? If the answer is yes, then you will have a need to file the 940s and 941s. For context, the 940 is the federal annual payroll tax return. 941 are the federal quarterly payroll tax returns. So regardless of being set up as a single member LLC or S Corp, if you are truly running payroll for anyone, minor children or unrelated employees, then you will have a need to file these payroll tax forms. 54 questions, oh my gosh. You guys are going today. Samson, if the business is profiting over 60K as an LLC, then I should look into moving. Generally, the easy answer is yes, but everybody's situation is different. A factor, like an easy factor in deciding if this is a good solution for you is, Samson, do you have additional W-2 income? If you do, and it's over 100,000 of income or wages, it can have an impact on how Social Security tax is assessed, which could potentially limit the savings opportunity of an S Corp. But if that 60K is your sole source of income, it's definitely worth considering maybe setting up a call with Collective and seeing if we can add that S Corp election for you. Okay, let's see, Marlene, how can you strike a balance between lowering your business profit enough to offset your taxes due, and then still being able to show enough profit if you are looking to get more? Okay. I'm not an expert in the real estate industry. I just know from personal experience and hearing of friends who are self-employed that the proof of income piece is challenging. If you put your business activity on the Schedule C on your personal tax return, and if there's real estate agents on here, lenders, Um, please call me out if I'm incorrect. This is just a trend I've seen. I'm not saying it's a rule. But I think it's more difficult for proof of income if you report on Schedule C on your personal tax return. For whatever reason, that income is not viewed the same, whether there's profit or not. The income's not viewed the same as like a W-2 salary. And so what's the balance? There are some people who are right on the cusp of that $60,000 profit who find an advantage of being an S Corp because it allows them to put themselves on a W-2 salary, which means long run, they can start accruing W-2 history to anticipate that mortgage loan. So in that instance, maybe the S Corp isn't valuable to you right now for savings. It's valuable for establishing a wage history. And that piece can be more advantageous for getting a mortgage. There are a lot of instances where people have no problems getting approved for a mortgage with the Schedule C income. And that could be due to like consistent business history. Like if you've been reporting on Schedule C for 10 years, you filed your tax returns on time, you see the profit is consistent. For some folks who are new to self-employment, that might not be the case. In which case having some kind of salaried W-2 income is advantageous. KP, what is the difference between the S Corp and C Corp? Okay, so there's some lingo that gets confused often between these two structures. An S Corp is the name of a tax status. A C Corp can be both a tax status and a legal entity, a legal corporation. An S Corp can exist, well, it has to exist as a legal structure first. So either an LLC or a legal corporation. Those are both entities that you file with your Secretary of State. They both give you liability protection, tax ID, legal business name. That's the bones for the S Corp tax status. The S Corp is what's considered a pass-through business, which means it does not pay tax, but the owners pay the tax at their individual level. So pass-through taxation is for the S Corp status. C Corp is the structure that truly pays a separate business level tax. So this is where this concept of double taxation comes into play. A C Corp, one, and like in the foundational structure, you can have unlimited investors, different classes of stock, international investors. So think like Amazon, Google. Big corporations that want to IPO will opt for the C Corp. They'll pay a flat business level corporate tax. I think it's 21% at the federal level. State level may apply. And then the owners pay tax again on the dividends that come out of the C Corp. So it's the true double taxation structure as a C Corp. So pass through means no business level tax, but the owners pay the tax. C Corps pay a flat business tax. And then again, when the dividends are taken out. In terms of deciding structure, this is not what you asked, but usually when you're a small business owner, it's just you, maybe a partner or one or two business partners. The LLC with S Corp status or the LLC with multiple owners is usually the best path for a small, closely held business. Okay, let's see. There's no way I'm getting through all these questions. So if you need to hop at 10:45 or if you want to stay on, I will stay on. We will keep recording either way. Jen, as a photographer, clothing and shoes are dependent on what type of job I have. Can you get a portion of it written off? Are they for you, like your clothes? Like you need boots to be on location? Again, generally regular clothing is not deductible. Like an outfit is just not deductible if you're going to a shoot. If you can call it a costume, like maybe you do home a themed birthday parties or something and you've got like boas and disco glasses or something, like that's truly a costume perspective, then it could be deductible. I have seen in tax practice people attempt to write off a portion of clothing. The risk there is that if it got flagged, the IRS would most likely disallow it, and then you'd just get your tax bill reassessed. Maybe if you're like, a travel like adventure photographer and you really like you're walking through rivers and stuff and you need waterproof boots, super specific, that may be an instance where, some of this can become deductible. Um, in that case, understand what the risk is. The risk is that if I were to get audited, the IRS could ask more questions. So have I documented the business purpose properly? And if they disallow it, am I prepared to either argue it or just pay the reassessed tax bill? Do you know where all the deductions? Do you know where all the deductions are for self-employment? Jennifer, I've got a list, or we've got a list somewhere that we can dig up that has a lot of common business deductions and write-offs. They're pretty generic, but it'll depend on your industry. If there's anything very specific to what you do, if you're a dietitian, your license renewal or continuing education, if you've got CPE, those types of things can be deductible. But we've got a guide that we can drop maybe in the chat. Sarah, I'm not sure if you're on and you have that handy, but we can drop that resource in there for you. See, can you do business deductions to reduce your Schedule C? Stephanie, this is a great question. She is asking if you can do business deductions to reduce your business profit while also choosing the standard deduction, or does itemizing deductions exempt you from the standard deduction? So two different concepts here. The standard deduction and itemized deductions refer to reducing your personal income. And so every taxpayer is allowed to optimize between standard deduction and itemized deductions. Standard deduction is like that, if you're filing single, like that 12,500 that the IRS automatically gives you, or they decide on this set of other deductions, mortgage interest, property taxes, charitable contributions. If you have those specific items and they total more than the standard deduction, you can optimize and choose to itemize those deductions and take the larger deduction. That happens regardless of your Schedule C business activity. So you can always optimize on that front between standard and itemized. Separately, you can always write off your business deductions to reduce the Schedule C taxable profit. I hope that made sense. Two different types of deductions, and you can simultaneously do both, is the easy answer. Do I need to file federal taxes if I had no income? Good question. No income or expenses last year as an LLC. If you're a single member LLC, then there may not be a need to generate the Schedule C. If you had no other tax activity, so like you're not on Robinhood or Coinbase with some investment activity, if you didn't have anything else to report, no other tax forms, you may not have a filing requirement. It's been a while since I've looked at what triggers or what turns off the filing requirement. I think it's usually if your income is less than the standard deduction, then you won't have tax anyway. An instance where maybe even if you don't have tax, what you would want to file is if you had like a salaried job and there were withholdings, you'd want to file to get your money back, to get your refund. But if there was no income or expenses, if the LLC existed already, you may still have to do like an LLC tax return that shows no activity. Depends on what state you're in. But overall, at a federal level, you may still want to file if you had other activity outside of that LLC. Can you introduce collective services compared to a competitor like 1-800-Accountant? Yes, Jay, I can do that. I might do that at the end though. I really want to focus on these tax specific questions. Short version is, contrary to some other platforms, Collective does bundle together all the moving parts of being an S Corp owner. So the payroll component, the bookkeeping component, the business tax filing, personal tax filing, all of that's under one login, one app, one fee, versus 1-800-Accountant may accomplish one or two pieces of the pie. and you may still have to separately source something else. So super high level, if you're going to be a single owned S Corp, everything you need is under collective's dashboard. How do you figure out what a reasonable wage is? What's the answer we learned today? It depends. The IRS is very vague here. The tax code says it needs to be, it's facts and circumstances based. So it depends on where you live, what's a comparable salary, what's your time commitment for your role, what's your seniority in the role. You may see something on the internet if you were to research about the 60-40 rule, where it's an allocation between 60% wage, 40% owner distribution. The IRS has not vetted that. Like there's no true percentage of your income rule that applies. I think when you see that rule, it could just be that's where people happen to fall. But you do want to do some high level research. Like if I'm in a big metropolitan area versus being in, rural California, the salary for a graphic designer might be different. And so those are things you may want to consider. So it depends. I'm sorry, I don't have a clear answer on that one, but it's very unique to everybody's situation. What is the deadline for a single owned LLC? File under my social security number. If you have an LLC, you will also have an EIN. If it's single owned, the activity will go on your personal return on Schedule C, and personal returns are due April 15th. There's another one here on reasonable salary that I'm going to skip since we just touched on that. This is more of a suggestion, comment rather than a question. Could collective offer a price break for other service instead of customers who have commercial property? And this will not get help from collective for their personal filing. So the personal tax filing through collective does accommodate rental properties. Yeah, let me find out what you mean. We usually don't discount, like the personal filing is an add-on service. So you could just opt to not use collective for the personal side. But the package with collective is really a bundle for supporting the S Corp. I have an LLC, but I pay myself a salary just like my employees. Am I doing it correctly? Samson, if it's a single member LLC that is not elected S Corp status, then you do not want to be on payroll. The reason is you have not elected to do the rest of the compliance that's triggered to allow you to do the salary. So you'd want to file that S Corp tax return, get approved by the IRS for the S Corp election, and then start paying yourself a true wage. In the eyes of the IRS right now, if you have not done the S Corp election, they still want to see self-employment tax assessed on your entire profit. And if you're paying yourself a salary without the S Corp election, you're paying less in Social Security and Medicare than they've approved you for. So a good solution may be filing an S Corp election so you can roll with that salary. 10:49, we're over already. I'm gonna take a quick pause to say that if you have to hop, we'll continue recording. I'm gonna get through as many as I can, maybe to the top of the hour. If you want to book a call, scan this QR code, talk to one of our advisors. Our team is amazing. They can answer some of these questions if I didn't get to them. If you come from a partnership, if your company or an organization referred you, ask for their referral code if you're going to join collective. That's my little pitch. If you've got a hop, thanks for joining. I'm going to blame it on you guys for asking a million great questions. We're getting through them kind of slow. I'll keep going. I'll keep going for 10 more minutes and I'll see what I can get through. But if you've got a hop, we'll send you a recording. Okay, let's see where we leave off. Stephanie, do I have to switch to S Corp right at the new year to have the whole year tax status? So the first question is, do you have an LLC set up? An LLC or a legal structure is the foundation for adding an S Corp. So if you have one right now, you are eligible to elect for 2025. There's kind of like, there's two answers here. The IRS has a deadline, it's March 17th this year, to file the S Corp election for this current year. It's considered a timely filed S Corp election. So Stephanie, you can decide by March 15th or March 17th if you want a 2025 S Corp election. If you don't know at that point, the IRS has a late relief process, which means you still file the form, you just put in a description on why you're, filing late, which would allow you to make this decision for 2025 after March 17th. So no, you do not have to decide right now. It may be worth booking a call with one of our advisors to see if now's the right time though. An advantage of doing it sooner than later is just getting like the foundational work set up, the payroll running, make sure your books are ready so you can kind of just be in maintenance mode if growth hits. That could be an advantage of making the call sooner than later. Paying estimated tax, is it most about state business tax, like 1% in California for IRA, assume since it's a pass through? No estimated tax needs to be paid. Jay, I am reading your question. I'm going to answer the first part. Is it mostly about state business tax, like 1.5% in California? So estimated taxes usually cover, well, there's one main one. Since you're a pass-through business, your business does not pay tax, but you as the owner pays the tax. So estimated taxes are usually calculated at the individual filing level. So federal, individual, you've got your business income, then maybe your partner works, maybe you've got some stock capital gains. And so estimated taxes are intended to pay into that combined total taxable income at both federal and state level. Then further, if you've got like an S Corp in California, like you mentioned, California happens to have a state S Corp level tax, and it's 1.5% of the business profit. In the instance that your state has that for the S Corp, you would also consider estimated tax payments at that level. For IRA, I assume since it's a pass-through for S Corp, no estimated tax needs to be paid. Again, if your state has a state level S Corp tax like California does, you would want to consider estimated tax payments at the S Corp level. But at the federal level, there's never estimated tax for an S Corp because it's passed through. Anonymous attendee, can you break down double taxation? We talked about this. Oh, wait, see, that can happen with LLC versus S Corp. How does it impact only the co-owners? So the double taxation, by the way, like the concept usually applies to the C Corp, where we mentioned like the flat 21% business tax and then tax again when you take dividends out. Double taxation in the context of self-employment is a little bit different. So I just want to clarify the verbiage there. What's happening between a single owned LLC and an S Corp is how much of your income is subject to the self-employment tax layer. And so without the self-employment tax, I'm going to, let's see. You can see how the screen share. This is an example of on the left, sole proprietor, single member LLC versus S Corp status. As a single member LLC, you've got your business profit on Schedule C. That entire business profit of 120 in this example is going to be subject to the 15% self-employment tax. What's not shown here, because income tax is a separate beast, but what's happening on top of that is you have your personal income tax rate assessed on top of that 18,360 of self-employment. So as a sole proprietor or single member LLC, the entirety of your profit is subject to multiple layers of tax. So it could be federal income tax, state income tax, and self-employment tax. So in this case, it's not double, it's 3 layers. When you add the S Corp status, you trigger this need to pay yourself a salary. So in this example, it's 45,000. Then under this process, only that wage, the 45,000, is subject to that 15% self-employment tax instead of the 120. So what's happening here is you're carving out a smaller portion to pay self-employment tax on. You still pay income tax on everything. It's now that there's just less on the self-employment tax side. Who does it impact? Only the co-owners. Yes, so only the owners will have like a profit flown through to their that flows through to their personal return. And then the wage. So owners usually have to take a wage as well. So this would apply to the owners, not regular employees. They would just pay income tax if they're an employee. Are you going to address an LLC filing as an S corp? Yes, that's exactly what we do. This presentation was really like supposed to be live Q&A about tax season deductions, but this is the meat and potatoes of what Collective does. Collective is intended specifically for single-owned businesses who want to add the S corp election to their LLC. So an LLC, super simple to set up in most states. You file with the Secretary of State. Again, it's what gives you liability protection, tax ID, legal business name. The downside is you may be stuck in this left column where you're paying self-employment tax on the entire profit. Once you add the S corp election, let's say like your profit's going to be 100,000 this year, you're fully committed to self-employment, you would consider adding the S corp tax status. Once you file the S corp election, it's like a simple 2-page form with the IRS. It tells the IRS that we're triggering all this additional compliance. We agree to paying ourselves a reasonable salary. We agree to maintain a clean and complete financial records, so bookkeeping. And then you agree to file a separate business tax return. So once you agree to this election, you agree to additional compliance, and that's when you can start to capture this, savings potential by reducing how much you pay in self-employment tax. When you file as an S corp, again, the downside is the administrative burden. So some alternatives to a solution like Collective is like a CPA. They usually focus more on just the tax filing. So you'd separately source like an accounting platform and a bookkeeper, and then you'd separately source a payroll solution, which is totally doable if you come from that world and you like to do it. More power to you. I signed my dad up for Collective as a tax accountant because I didn't want to do it. So it's doable. It's not hard, it's just annoying. And so the alternative to even having a CPA is completely doing it DIY. You TurboTax this business tax return. It's more sophisticated than an individual filing. It has a balance sheet. The return needs to equal each other out. So at Collective, we bundle all of that together for you if you choose to opt for the S corp. Oh my gosh, I feel like I'm so slow. I have no idea how many I've hit on this list of 71 questions. Let's see. Anonymous attendee. I have not yet created my LLC, but plan to in the next 2 weeks. Can I deduct anything from 2024 as part of my startup costs? Yes. You don't have to have an LLC in place, in which case you would be considered a true sole proprietor. Make an Excel spreadsheet of what you paid for to get set up for business, and you can put it on a 2024 Schedule C. What the IRS is looking for is intention to show income. So they're looking for a trend. This is how they negate like the hobby rule, where like if I just make bracelets for fun and I want to write it off, but I never show revenue or even profit, then the IRS could flag it as like not a true business and disallow those expenses. But sounds like what you're doing with education and training, that's really gearing up to start selling your services. So you can definitely deduct it. My revenue last year was 100% out of state, but still less, okay, less than 25,000. For state taxes, I deducted 100% as out of state services. Should I open another LLC, or my revenues are mostly having single member LLC? Anonymous attendee. So you're talking about having earned income outside of your resident state. Usually, you want to form and operate your LLC where you reside, because that's where you're a taxpayer. All of that business income, whether it's earned elsewhere, still goes on your resident state filing. So you still pay state level income tax there. You may consider a foreign registration instead of a brand new LLC to the other state where you conduct a lot of your business. All that does is like it'll tell Washington State that you've got a California LLC that has business activity. And so it's just creating a business presence in both states, but still keeping your main LLC intact in your resident state. So opening another LLC is usually more costly and complex. I would say a foreign registration would likely achieve the compliance part. Hi, Deb. You're back. Let's see. LLC is mine, but I file as married with my spouse. Do I need to change that now because I have a solo LLC? No, you don't. You can be the sole owner of your LLC. It's just that now that business activity is going to go on a joint tax return instead of a single tax return. But no, your partner does not have to have ownership in your LLC. There are some community property states where if an LLC is owned by one partner, effectively the other partner has half ownership. You're seen as one taxpayer. There could also be rules there about when that LLC was created, like was it a premarital asset or not? Short answer though, Deb, you do not have to change the ownership. I'm gonna do a couple more because there's no way I'm getting through all of these, and I do apologize. We'll figure out a way to get you all the answers. So feel free to drop. I think we're at the top of the hour. I'm gonna do one or two more. Jay, if I plan to get an MBA, can I have my S corp pay the tuition as a business expense? Is it a good tax strategy? Um, it depends. I think hmm. I'd have to think about that one, Jay. I'm not sure. It really depends on the business purpose. Like, is it related to what your S corp is doing? Um, and truly, I'm not sure how education programs to that extent become deductible for your own S corp. So let me think about that and try to get you an answer. I don't know. Usually with continuing education being deductible, we see things like certifications or workshops. I don't know about a full MBA and if that is even considered different enough. Which provides the most legal coverage liability wise, PLLC or S corp? So S corp itself is a tax election, and so underneath any S corp, you're going to have a legal structure, which could be a PLLC, professional corp, regular LLC, regular corp. In terms of liability, I don't know whether or not a PLLC versus a regular LLC grants more liability protection. I don't believe it does. If you live in a state that requires you to have a PLLC because of your license, just from a compliance perspective, you'd have to form that. And it will give you some liability protection and separation. I think most often people will pair their LLC with like business insurance. What happens if a client doesn't or won't send me a 1099? Regardless of receiving a 1099, you still want to report all your income. That is the correct answer. Stephanie. Okay, let's do a couple more. Let me see how I'm doing on time. The rest of the team. Okay, a couple more. 5 more minutes. This is kind of fun. Okay, Yesenia, I only have an EIN and have not opened any LLC, S corp, or anything. Do I still need to file for taxes? I have not made any money as I am on the beginning stages of my business. If so, what forms do I need? Yesenia, it sounds like you have a sole proprietor EIN, which is protecting you from having to give out your social security number. What that means is you do not have a legal structure, so that's totally fine. All that business activity would still get reported on that Schedule C of your personal tax return. So for 2024, if you go to TurboTax or H&R Block or whatever, you'd probably choose the self-employment option, which will generate that Schedule C on the personal return. Again, if you have not made money, but you're gearing up to, like you've got startup costs, you'll want to claim those deductions. So just populate the Schedule C, and that will be sufficient for 2024. If and when, Yesenia, you do decide to form a new legal structure or you're profiting enough and you want to set the stage for an S corp election, You would form an LLC and you would get a new EIN, and then the old one would just go into the void. And you'd open new business bank accounts under the new LLC EIN. So when that time comes, just a heads up. What is some from Trisha? What is the new 1099-K that I received from Square this year? 1099-K is a summary of payments. Actually, let me level with you because I've been out of tax for a while. I'm not as familiar with the 1099-K as I should be, but I believe it's a new requirement that summarizes payments from all like vendors. It should summarize all or give you a glimpse of what your revenue should be when you do the tax reporting. So it's really intended to, I think, match up to what you've billed out of certain vendors like Square. Let me find you a better resource because I butchered that answer. I'm sorry, Trisha. What is the percentage of tax for S Corp versus LLC? Jennifer, this is your question. It's a good question. It really depends on what your personal income tax rate is. Again, because an S Corp is pass-through business, it means the owner pays the tax, not the business. Your personal income tax or situation can vary greatly. Like it depends on if you file single, jointly, if your partner has other sources of income, if you've got rental properties, all of those contribute to your total household taxable income. And then your tax status determines where your tax rate is. So the percentage of tax is going to vary for everybody, whether they're structured as an LLC or S Corp. Both have the same self-employment tax rate, 15.3%. The impact or the savings opportunity just depends on where you land with the salary if you opt for S Corp. Any special issues or things I should know surrounding an LLC filing as an S Corp? Anonymous attendee, just be prepared for all the compliance that's required. Filing the initial election is very easy. And a lot of times folks will say, I filed the S Corp election, but I didn't do anything after. That's where the issues come in, is if you don't have a support system or haven't learned about the additional compliance that comes after the initial election, that's where you can start getting into trouble with notices and penalties. And so high level, make a plan for bookkeeping. Payroll solution is critical. That's how you pay yourself the reasonable salary. I mean, it needs to run through a formal payroll process. And then filing an annual business tax return, all of which can be done through collective. That's it. The compliance is a pain, but can be worth it from a savings perspective. As an S Corp, if I have 20,000 of profit at the end of the year, should I pay myself more and pay a higher personal federal tax? I know it depends, but let's say usually. Anonymous attendee, this is too much math. There's too many numbers in this. Okay, let's see. If I pay myself more and pay a higher personal federal tax, I know it depends on my personal tax rate. You pay income tax and it'll be the same income tax rate whether you're paying on profit or distribution. So really you want to look at your salary income in comparison to your business activity as a whole. So if you've got remaining business profit of 20,000, but you've already paid out a wage, you're probably fine to leave it as is because you're going to pay income tax on whatever's left over regardless at the same rate. It's still both a wage and the remaining business profit contribute to your total taxable income the same way. So your personal income tax rate is going to be the same regardless. I don't know if I answered that question properly. Can you send out a list of deductions? Yes, we can do that. How do I pay my son through a 1099? We also have a great resource for employing or paying family members. There's a lot of rules revolving minor children too. So you just want to make sure you're compliant with like labor laws and you're paying them a reasonable wage. But we've got a guide about how to issue 1099s. If you pay someone on 1099, it can literally be like Venmo out of your business checking account. You can write a paper check, you can write cash. The reason it's so easy to do that when someone's 1099 is you don't have to do formal withholdings. So you can literally just give them money, and then clock it to see if you need to issue them a 1099 at year end. It's 11:10, which means we've gone 25 minutes over. So I'm going to pause there. We will figure out a way to address the rest of the questions. Maybe we'll just, pause, hop off, and continue recording responses. Thank you for the participation. Really appreciate it. I might not have even gotten through half of these questions. All great questions, all valid. There are no dumb questions here. We'll make sure we get you the answers. And if you are interested in meeting with an advisor, scan this QR code. The rest of our team is as helpful as we can possibly be in this self-employed space. So book a call. Again, if you come from a partner, please ask them for their referral code, get a discount when you sign up. And we look forward to connecting soon. Take care.